Hi guys, welcome to another portfolio update. This is portfolio update number 18 in October of 2025, which was a month of small but important changes. And there's one position that I decided to move on from, not because it was risky, but because it just wasn't doing what I needed to do anymore. It paid a steady dividend, but the price barely moved. So I made a decision that I think a lot of investors eventually face. Do you hold something that feels comfortable, or do you move that money somewhere it has a better chance to grow? I'll walk you through what changed, what I learned, and how it's shaping the way that I invest moving forward. My name is Darren. I am just a regular Canadian who used to think that it was too late to start investing. I started at 50, and I am proving every single day that it is never too late to build wealth. Last month, we were sitting at $423,000 in the portfolio, and this month we've jumped up to $440,000. Of course, we're on October 30th, so we got one more trading day to go, but I wasn't able to get that video done tomorrow. I'm doing it today, so you will have to see what happened on that last trading day in the next portfolio update. Now, I want to give a big shout out to my audience because I noticed in previous videos that 80% of you were not subscribed, and I asked you to hit subscribe because it really helps get the message out. And guess what? You guys crushed it. We've dropped that number 10%. We're now sitting close to 70%. Subscribed and watching. What can we do next month, guys? Can we drop that number even further? So if you're watching this, like and subscribe really helps support the channel and gets the message out there. All right, guys, so like I said, I'm getting closer to my goal. I'm 88% of the way. We're using Passiv if you're new here. Passiv is a great way to track all of your dividends, your portfolio. It brings everything together in one place. And I use two different brokers, so this particular app allows me to link those together and track all the metrics. And as we go through today, we're going to use this as well as another one called Wealthica, which gives me a global overview of everything in the portfolio. So like I said, we're sitting at $440,922. Now, what's interesting is a couple of days ago, this was up to $445,000, but over the last 1 to 2 trading days, we've seen a slow dip in the markets, and that's completely normal. If you're new or you're kind of getting started investing, these are natural roller coaster rides you're going to go through. But you need to think of it this way. If you're looking at that change in the markets today where you see that dip, you have to zoom back out over time, because eventually that what looks like a very big dip will eventually average itself out and it won't quite look the same. And I'll throw a metric up on the screen here. This will be VFV, and you can see some of these dips in here. And if you zoom back out, it looks pretty much like a straight line over time. So when you see that, don't panic. It's completely normal. Now, I'm pretty fortunate that I have access to a calculator through the Enriched Academy. It's a Canadian company, and they are a financial company, but they don't just do financial advising. They also provide a basis for learning as well. You can listen to online seminars, and you can really learn a lot from these guys. But one of the tools that I really like, which are among many tools they have, is a planning calculator for when I retire. So I learned in 2023 that we didn't really or weren't really prepared for retirement. And so what we had to do was start preparing our money for that period of time. But how do you get there? Well, you need some tools to do it. And this calculator has really helped. So I have about 8 years before I'm going to retire, which you can see in the top corner here. The goal that I had originally set was $500,000. Now you're probably asking yourself, why $500,000? It's because I have a pension. So this money will be my wife's for the most part, and it will supplement the pension, and we'll be able to retire comfortably on this. And what I did is I told this calculator, this is how much salary we would like to have when we're in retirement. And then you plug in all of your numbers for how old you think you're going to live, how much your current portfolio is, what rate of return, and I use a very, very conservative number of 5%. So if you've been around for a while or you're learning about the investment, generally it's a little bit higher than that, but I figured 5% was fairly conservative and we could use that. So for the future goal, The calculator is telling me that what we actually need is $577,000. So I need to update the goal that I set in Passiv, and it's actually very easy to do so. All I need to go into Passiv and then go down into the settings. So all I need to do is go down into the settings. I'm telling it how much I'll be contributing. It's trying to figure out how long that's going to take and when I'll be retiring. And then all I do is I change the target. So up here, it's now going to be $577,000. And then once we're done that, we ask it to update itself. And then it sets out the goal for how we're going to get there. And now back to the main page, we can see that the target, which originally said $500,000, now sitting $577,000. We were 88% of the way there. We're now 76% of the way there. But that's okay because we have set a foundation. We've invested on a regular basis. We're dollar cost averaging. We're seeing the portfolio grow. We're getting closer to that goal. So that change does not bother me at all. Now, if we switch back to the calculator that I was looking at, it's also going to tell us at the current rate of investing how much money we will actually achieve over that time. So we said we needed $577,000, but at our current rate of investing, we will actually have $1 million by the time we get to the time of retirement. That time frame I said is 8 years. So we're actually going to have a surplus of money. That's good because I've always told people you got to have a relationship with your money. I don't want to be the person that's investing every single dollar that I have. I want to be able to enjoy my life now because let's face it, nobody wants to get to retirement, retire, and then all of a sudden get sick and not be able to use that money. Of course, it could be legacy. I could pass it on to the kids or whatever the case may be, but I want to enjoy my life now. What makes me feel good about this is I set a foundation. I've learned the basics. I consider myself a novice now, and we're getting closer to that goal. And a big part of that is our money is building money. So I'm putting money into the account, and I'll show you how much went in this month. And that money is growing money out of itself. That's the compounding effect. That's the biggest thing that I've learned. It is so incredible to see your money growing each and every day. So we'll just take a quick look at the entire portfolio as far as the metrics go, how much we've earned, how much is in the account, and so on and so forth. So you can see at the top we have the contributions that we've made. Now there's 3 distinct big increases at intervals. Those are money being moved. Unfortunately, the one downside to Passiv is that when you're moving money around, there's no way to tell it that you actually moved money from one account to another. And so unfortunately, it kind of skews some of those metrics. You can see by the lower ones here that we're making steady contributions every single month. So I've set out a certain amount, and I'll go over that when I go over the monthly part. So the nice thing about it is it's kind of motivating to see this here. There's a contribution streak part. So it shows when you might have missed months contributing. And you can see here that every single month I've been putting money into the markets. Whether it's a small amount or a large amount, it doesn't really matter as long as you're putting money away. Of course, I like to set the amount and then it's set it and forget it kind of thing. So the rate of return on this account in its totality with all the accounts is 27%. Now, that sounds pretty juicy, but you got to remember one thing right now. If you're watching this video right now the stock market is on fire in a bull market. And every so often there are market corrections. Like I said today, 2 days ago, the markets were quite a ways up around, and my portfolio's now dropped about $5,000 or $6,000 in 2 days. That's quite a bit of money to a lot of people, but you gotta, like I said, zoom out, wait, and watch and ride that out and don't react to that kind of stuff. All right, so the average monthly dividends that we're getting on this account, we can see a nice steady increase in them. So right now we're averaging $687 a month. And you can see that, for instance, in this month here, because some of the holdings that I have, they only pay out once a year. So there will be a period of time when there's a big payout. So we get that big spike. And in that month, we had $2,036 in dividends and distributions. This last month was $1,345, and we'll look at a little bit more on that in a second. And right underneath that chart, you're going to see the total dividends for each holding for the period of time that you've been holding. So this top one here is HYLD, and it's paid me a total of $3,850 in distributions. And then you can see they steadily going down depending on how much each of them are paying out. Now this portfolio sitting today at $440,000 has earned a total of $21,588 in dividends. And a great part about Passiv is we can break things down. So now we're going to look on a more smaller micro level, which is by the month. So the first part is how much we contributed. So we contributed $4,885 into this portfolio. Now some of you are going to look at this and say, well, I can't do that. Keep in mind, I started investing a little over 2.5 years ago and had a lot of ground to make up. I'm also in my 50s with a fairly well-established salary. So yes, it does seem like a lot. It doesn't really matter what you put into the markets. Ideally, the ratio I like to use is 20%. So whatever you're earning, about 20% of it should go into the markets. But that's completely up to you. It might be 5%, it might be 10%. You get to decide how much that is, and you have to marry that up with, what's going to make you happy, having that relationship with your money. So don't look at this number and think, well, I can't do that. You can do the same thing. It will just take a little bit longer for your money to grow. That's the only thing to remember. But after that first $100,000, the momentum really starts to take off. And the more you put in, the more things grow. All right, so the net change in the account this month was $13,671. So from last month to now, that's how much it's grown. Of course, that also includes what I contributed, which gets broken down. So it says that the rate of return was 2.71%. And underneath that, you have your investment actual growth. So in that last month, outside of the contributions that I made, it actually grew $8,786. And I didn't have to do anything. Once I put my money into the market, it did that all on its own. Again, snowball effect. The more I add, the more it grows. You're earning interest on top of interest. So as I said, this past month, we earned $1,345 in dividends. The last day of the month is one more payout on dividends, so there will be a little bit more that gets added to this. Now, I use Wealthsimple, and for all of the different platforms that I use, I have links in the video description below because it is a great way to support my channel. I don't take sponsorships right now. I've made an effort not to do that because I feel like if I take a sponsorship from a particular fund or platform, then I feel like I might be obligated to say things about that platform in order to receive, the money that they might give me for being sponsored. I would rather be open and honest about the things I use. If I'm using them, you're getting my honest opinion about them. And that way it's, natural that I'm not being guided by anybody to give you this information. So like I said, in the video description below, there are links to everything that I use, whether it be EQ Bank or Wealthsimple. And if you're going to get started, it's a great way to support the channel because when you use it, I actually get a referral fee for you signing up. And of course, there's always those days when I have to edit videos, which does take a fair amount of time on top of my regular job and being a dad. So there is another link down there to buy me a coffee. It's a really easy way to buy me a coffee to keep me motivated while I'm sitting around either shooting the videos or editing them. Okay, so we're in Wealthica, and I'm just gonna give you like a total global overview of everything in one place. So for each holding, when you click on the holdings, you actually get to see how much of each holding I hold, how well they're performing. So we'll take the one at the top, that's VOO. So if we go across the screen, we can see that we're in the green, so we're doing well. We like green. Red obviously is not the greatest, but when we see red, we don't panic. We have $83,225 invested into VOO, and the market value, so that's the unrealized gain. So if I was to sell all those shares, I'm gonna get $104,000 out of that. the weighting within the portfolio from all of my accounts, because this is all of them put together of all the holdings I have of VOO. And the way you check that is you open up this tab here and it will show you which of the different accounts I have and how much each holding. So for instance, I have some in my wife's RRSP, some in my RRSP, and some in Questrade. So we can see that the weighting, the total weighting for this is 22% of the portfolio from all of the accounts. So it's a great bird's eye view to see what those holdings look like. And you can see the unrealized gains sit at $20,000. And then the last metric you can see is the appreciation, which is a 25% return on that investment. And then we can just go down all of them. Now, one comment that I've been getting is that I have some overlap in some of the funds that I have. And that is true. There is no doubt about it. But you have to keep in mind as a beginner, when you start out, you are going to make, you want to call them mistakes. And of course, when I started, I didn't know what I was doing. I tried to prepare myself, but that's why I share these videos. Is if I could give you one piece of advice, it would be start simple. It would be start with something like an all-in-one. And there's plenty of different ones out there. The one that I use is XEQT, but there are other ones and you should look at them. But the nice thing is you can invest in it, be diversified, and have your money working while you're trying to figure out what to do. Now, it's not the only way to start, but it is a good recommendation to get started. So when I started, I kind of took the shotgun approach, and now I'm trying to figure that out. So when people do have some comments, which I do appreciate, I always like it when you guys leave comments. I want to know, if I'm making a mistake, what is the overlap? And if so, what are your suggestions? And I will take and consider those suggestions and try to implement them. So for example, in XEQT, there is US exposure, which is what VOO is, which is why I get comments where there is overlap. But what I want to point out is that each different account that I have, and there are many of them because it's my wife's and hers, or pardon me, my wife's and my accounts, I have different holdings. I set them up slightly differently, but when we blend them together, there does look like there's a lot of crossover with the different holdings, or duplication, you might say. So as we go down the list, all we're doing is going through all the other tickers. The one that I want to point out is I do have a large holding of covered calls. It's about 12% of the portfolio. So 90% in equities and 12% is in covered calls. The one that I have the most in right now is HHIS. It's about $26,000 in that. And there's some unrealized gains at $29,000, which works out to about $2,600. So that's, and obviously we can see it's about 6% of the portfolio. And obviously we can see that there is a 10% gain in that position overall. Now, it's important to note that this type of fund has a lot of distributions that are not part of that. So if I'm reinvesting those distributions back into this position, it would actually be a lot, not a lot higher, but it would be definitely higher than what you're seeing on here, because these types of things don't calculate that. Now, I used to have my drip set on, so that's when your dividends come in, they get reinvested back into the same holding. I've changed some of that, so I'm deciding where those distributions want to go. But the long game is that you always want to look at your total returns no matter what your strategy is, whether you're a value investor, to cover call investor, a growth investor. Your total returns are what matters. So that includes those dividends that are reinvested. Now, obviously, if you're retired and you're withdrawing some of those dividends or distributions, that changes the game. But for the vast majority of people who are building their wealth, total returns include the reinvestment of all of those distributions. Now, I mentioned in my intro that I did make one small meaningful change this month. So I decided to sell one of my dividend holdings. And like I said, it wasn't a bad investment. It did pay consistently, but over time, the price just didn't move. Lots of ups and downs, but no real progress. And when you look back a couple of years, and the share price is still sitting near where I started, you start to ask yourself, is this money working hard enough? So I sold this position and reallocated the funds to my growth side into ETFs that are actually compounding over time, like I showed you there, like VOO, for instance. So the position that I'm referring to is PLZ.UN. It is a REIT in Canada. And like I said, the price kind of fluctuates, as you'll see by the chart that I'm showing you here. But unfortunately, the price appreciation, the growth in the company just isn't there. Now, one thing I'll admit is, while I know who the company is and I know the basics of what they do, I didn't take the time to learn enough about the company's books. What do I mean by that? How much money are they bringing in? What are they doing with that money? Are they trying to grow the company? Will the share price grow? Now, if you look at this position as a dividend producer, which REITs typically pay out a large portion of their funds back to shareholders, then that's fine. But I've held this position for 2.5 years because that's how long I've been investing, and I really don't see a lot of growth. And even when I looked at the charts looking back, I just see it as a steady eddy. So it pays a decent distribution, has a very low share price at just around $4, but it's not a growing company and I don't see the share price growing much. So rather than keep it in there, I decided to sell it. That's when I realized something. I'm still in my growth years, and if I'm holding something that's just sitting there, even if it's paying income, that's not an opportunity cost. So while I'm not abandoning income entirely, I'm being more selective, saving those dividend positions for later when income actually matters more than growth. Now, one viewer pointed out something really smart. After I added VTI to the portfolio, they noticed that I'm now holding VFV, VOO, VTI, and QQC, and there's a lot of overlap. And they're right. VFV and VOO covers the top 500 companies in the US, or the S&P 500. That's your blue chip stocks. And VTI covers the entire US stock market, including those same 500 companies, but it also has mid cap and small cap. All right, let's get into each of the accounts. Now, if you're new to me, I have several different accounts. I got the spousal account, the TFSA for my wife's RRSP, my RRSP, my TFSA. And the original reason I started the channel was to show me maxing my TFSA out because the TFSA is such a powerful tool in Canada. Your money will grow tax-free, where in my RRSP, in my case with my pension, I'm adding income that could potentially be taxed higher when I take it out. So instead, I use a spousal RRSP to offset some of my income and give it to my wife. So we're going to start off with the spousal because that's one of them that we are funding. I did start a bit of a case study on emergency funds because I had to use my emergency fund recently and I was looking for different ways to make that money grow, and we're going to touch on that account in a bit to see where it's at. Good news though, there's some fun things happening in there. All right, so my spousal account, which is the one that I fund and my wife takes out later in life, is sitting 92% accuracy with our asset allocation. There's no money, basically $12 in there, which isn't very much. The total value is $127,493. And of course, it's made up of a bunch of different positions. So we'll look at the metrics within that specific account. Now, the reason that I mentioned the emergency fund is that I had to divert the money that I was investing into the spousal RRSP over to the emergency fund to build that back up because having an emergency fund is so important. So this past month, there's only been $43 that's put into the spousal account, but that's going to change next month. So the net change in the account over the last month was $3,132, a rate of return of 2.89%. The investment growth, though, is $3,089. So we can see that there's this nice compounding effect going on in there. So the average monthly dividend income in this account is $404, with the total amount over the last month being $391. So nothing really much to write home about, but there's definitely some compounding going on. It's growing, as you can see. So the next account that I want to show you guys is my TFSA. This is the one that I am making regular contributions to. It's automated, one of the great features of Wealthsimple. All you do is you set it up and you forget about it. So every 2 weeks when I get paid, it's automatic. That money goes straight into the account, and then I decide where it's going to go, but I could automate those investments as well. So right now we're sitting at 97% accuracy. There's only $9.23 in here. The total value of this account is $84,528, and it's split right now because I took advantage of a Questrade offering, which ideally I do kind of regret taking advantage of. But either way, part of it's at Questrade. With now I'm investing back with Wealthsimple because I really like Wealthsimple's platform. All right, so in this account in the month, we contributed $2,244 to the account. And the net change in the account for that month was $3,903, with investment growth of $1,659 with a rate of return of 3%. The average monthly dividends in this account are $281, and the total dividend income for the month was $271. And I'm just going to touch on one account that I added recently that's starting to grow over time, and it is Bitcoin. I made the decision to start putting some money in here. Incredibly small amount, as you can see. The value of this one's only at $157, but I felt it was time to start looking at that, and I figured this was a good place to start. And as I learn more about it, I'll figure out where the best place is to invest it. But this is set up, it's automatic. So every week I'm investing $10. I don't even have to do anything. It's that easy. It goes in automatically and it gets invested automatically and I don't have to touch it. Now this is the account that I was really excited to share with you guys because this is the one that we're doing a little bit of a case study. We're going to try and figure out, is this a worthy way of dealing with your emergency fund? Not gonna lie, I know that I'm taking on a lot of risk by doing this because if the markets take a big swing, I might not be able to access all this money. In general, an emergency fund should be something that's liquid, but we're going to try and set this up so that we have some liquidity and some part of it invested that we can access. And it's also a psychological thing. I have it in a separate account, and that way I can actually look at that money and know this is the money that we're gonna rely on should we need to take it out and take care of some emergency, or if my wife was to get laid off or whatever the case may be. So we're 96% accurate. Now, we have $10,347 in here. So the goal for me was to build this back up to $10,000. The total value of our emergency fund will be $20,000. So the remainder of it is sitting in our other account. So I basically split it. So I have some liquidity, but I also have this part of the emergency fund making some efforts to grow. So let's look what's in it. And I made a big change in this account as well. I really giving it some thought. And some will say, well, you have some overlap in here. But here's the thing is, we're comparing it against covered calls. So that'd be an income approach and a growth approach. So 50% of this money is in a growth side and the other 50% in covered calls. But I added one position because I think it makes a lot of sense. So originally I chose VFV because it's the S&P 500, it grows, it's a growth fund. But then I got thinking, I talked to you guys a lot about XEQT and how that's such a great diversified fund. So if we're going to have a true measure of what and how it's performing, I think we should be comparing it against XEQT as well. So I balanced this out. So I sold off a bunch of the VFV and I put it into XEQT with the last bit of funds that I put into the account this week to top it up to 10,000. So right now we have 25% in XEQT, 25% in VFV, and then the remainder is split between HHIS, USCL, and HYLD, which are all covered calls and they're all generating income. So we're going to jump over and we're going to look at what that income looks like and what the metrics are in the account. Okay, so over this last month, we put $2,645 in this account. The net change in this account, $2,990 with a rate of return of 4.71%. Investment growth was $345. And the average dividends in this account right now are $58. And of course, the more we add and the more it grows, the more those distributions or dividends will grow as well. And if you want to see how I got to today by structuring the portfolio and building it up over time, you should watch this playlist right here.